All right. Today we have a lot to talk about because we are starting to get an impulsive sell off from what could be critical resistance around SPY 460. But I want to warn you about assuming things are going to happen, and I'm going to give you a lot of reasons why you should be looking at the market slightly different than what you may already be thinking. So first things first, SPY was down 1.39% today, which is one of the biggest drops we've seen for quite a while now because we've been in such a strong bull trend. And the first thing people are going to start doing is freaking out because of the credit downgrade and wondering if SPY is about to crash and go to much lower prices and the bear market is coming back and all of these other bearish narratives that are likely going to come out. So the first thing you need to realize is from the closing high to where we close today, SPY is not even down 2%. And anything between 3 to 5% is just a completely normal pullback. So we are still well within the realm of possibilities that this is simply a pullback to support before we go higher. Now you could be sitting there thinking, how the hell is he talking about going higher? This is a bear market. We're going lower. Everybody's bearish. We're about to crash. We're about to go down 20%. Doesn't he know what's going on in the economy and all of these other reasons of why you could possibly think the market can't go higher? And I'm going to completely objectively erase all of those narratives very easily and very quickly. The first thing I want to do is I want to simply just go look at a chart of Caterpillar. And this stock just reported earnings and had a very impulsive breakout to all-time highs and held that breakout for the second day today. And you are not going to see a stock like Caterpillar, which is in the industrial sector, breaking out to all-time highs in a bear market. It's just not going to happen. It's never going to be a possibility in a bear market that an industrial stock is breaking out to all-time highs. Next, if we jump over to the industrial sector as a whole and we zoom out and we switch this over to a monthly chart, you can see the entire industrial sector is still trading at all-time highs. Yes, even after today's red day. Now you could say, well, that's the industrials. What about the tech sector? And if we go over to a monthly chart of XLK, which is the tech component of the S&P 500, again, the same exact thing with last month just breaking out to all-time highs. And so far, we are just back testing that breakout to all-time highs as support. So if you just objectively zoom out and you look at the actual stocks moving the market, a lot of these sectors and a lot of these names are still in very powerful bull trends that are breaking out to all-time highs. And if you think that happens in a bear trend, well then good luck to you, because I just don't see how you could possibly think there is a bear market scenario with a lot of these sectors breaking out to all-time highs. So now if we just look at the XLK compared to the Qs, you can see the Qs are very close to all-time highs. And with the XLK sector breaking out to all-time highs, it's likely the triple Qs are just lagging behind. So yes, you can easily take the price action from today and you can go pile into short positions and you could say the sky is falling and we're about to crash. And you may be correct, and that is still a possibility because anything is possible in the market. But I just gave you very objective reasons why we are likely in a bull market, and you need to treat every pullback to support as a buying opportunity while you're in a bull market, or you are going to one day look in the rearview mirror and seriously regret missing this entire rally, which a lot of you have likely already done this year because we've already had a very impressive rally off the lows. So just looking at this chart, did we see anything in today's price action that severely limited the possibility this could still be a bull trend? And the answer is simply no. We broke down through what was one of the critical support levels, which was SPY 452. And that is reason to be a little more cautious. And I'm going to go over the price action you need to be paying attention to. But as you can see, looking at the trend, we are still sitting right on top of the rising 20 daily moving average. And we are still sitting above this support level at 448. Now, yes, it is a possibility this pullback goes all the way down towards the gap fill at 443 and retest that breakout from the June 15th high. And that would still be a potential higher low before the next higher high within a bull trend. So that is completely possible that we do go a little bit lower. And as I said in the introduction, pullbacks are generally anywhere between 3 to 5%. And that gap fill is only about 3.3% away from the closing high. So yes, it is completely possible that we go a little bit lower before we find significant amount of buyers to send us back to higher prices. Now, do not write off the possibility we bounce right from the rising 20 daily moving average, and that support is right around 450 and the support just below at 448. So going into tomorrow, manage your risk right there, right around 450 to 448. And if we break below it, then yes, we are likely going down to fill the gap at 443. And then we'll likely see support somewhere around that zone, which is also going to be the rising 50 EMA. Now, also pay attention to the fact that we did gap down. So we also have a gap to fill to the upside, which is above 455, which is also the previous previous support level. So if we do start to bounce, it is possible we fill that gap and make another lower high and then still go down and fill the gap at 443. And then of course, because we're in a bull trend, it's possible we just continue to blast higher and we got the pullback before the next higher high. So with all of these things as possibilities, the only way you're going to know how to trade this market is managing your risk around critical levels. Pick a direction, and in a bull trend, I suggest looking for opportunities to buy at support. But if you're bearish and you want to short at resistance, then you're looking to short somewhere around that gap fill at 455. Keep in mind, only the bears that recently shorted made money today. If you shorted the close, you are very unlikely going to make money, and you took a very low probability trade because you just shorted at support in a bull trend. It doesn't guarantee you won't make money, but you have a very low probability chance, and you took on a lot of risk to short the market if you shorted the close. So get in the habit of shorting only at resistance, and the previous place to short from was the previous high of resistance at 460. And if you did that, then you made decent profit. However, if you just piled into short positions at the close, you shorted support in a bull trend and you're not likely going to have a very good time tomorrow. So the only way we're getting more bearish from here is if we continue lower and breaking through all of this support and then start to lose this bull trend. There's still going to be plenty of room to the downside if we're going through a deeper correction. So know the critical support levels between 448 and 450, and if we break that, we're going towards the gap fill at 443, and the upside resistance we're looking for is right around that gap fill at 455. Jumping over to the NASDAQ 100 triple Qs, we were down 2.19% today, and the triple Qs did fully close that gap right around 374. And this is also the critical support the bulls need to hold. So it is still possible the bulls find support at 374 and continue to bounce higher. However, we cannot rule out the possibility this is a lower high, which I talked about last night, from 383. To go fill these lower gaps around 374, which we filled today, and the next gap is just above 368. This is a completely normal pattern to do an ABC down to fill the gaps and then still find a higher low to continue the bull trend at a later date. As you can see, this would fill the gap and we would also find support right around the rising 50 EMA. So it is possible the triple Qs are going a little bit lower. However, it is a little obvious that that is a likely scenario, so don't be surprised if there's some bear traps along the way, which means we could bounce tomorrow and make it a lot more difficult to decide which direction we're going. So for that reason, manage your risk right there at 374, which was always the game plan all along of whether or not we break down below 374 or test it as support and bounce off of it. So the triple Qs are going to have a gap to fill to the upside just above 380. So if we bounce from 374, it is possible we go straight to fill the gap above 380. Just like SPY, that could be a lower high rejection, so watch it very closely and pay attention to whether we gap up or down tomorrow. If we gap down, the sellers are very strong and we're likely going straight towards that 50 EMA of critical support right around 371. On the Dow Jones, we were down 0.97% today, and we're still sitting at this support of the breakout at 353. And if we continue any lower, we're looking for the gap fill at 350, which is also going to be support at the rising 20 simple moving average. If we continue higher, we're looking for that price target up there at 360 and manage risk right around this level at 353. Whether we're above or below it is going to tell you which direction we're heading. On the Russell 2000 IWM ETF, we were down 1.36%, sitting right on top of support at the breakout at 195. And if we continue much lower, we're looking for support right around 193 and the gap fill at 190. Upside resistance remains 198 and 201. On the RK ETF, we were down 5.58%, coming back down towards this critical support zone at 46. And remember, this ARK ETF is in the process of trying to break out of the bear market, which means we may spend a lot of time around this bear market resistance to test it as support before we continue the bull trend. Manage risk as bulls right there, right around 46. And if we break below it, it could have been a false breakout and we could be going to lower prices. The VIX was up 15.49% today, breaking above 15, which is the first sign we need to be a lot more cautious, because remember, the VIX above 15 tells us that people are starting to panic, and when people panic, they typically sell, which could drive prices lower. Now keep in mind, the VIX did try to spike out above 15 back in early July and instantly got crushed back down, so we can't rule out the possibility the VIX is not going to go much higher. However, it's a lot better off to be a little cautious while the VIX is elevated. On Bitcoin, we're currently down about 1.8%, and Bitcoin is finding resistance at that negatively sloping 20 daily moving average and that resistance zone above 29,000, which could mean we're going to spend more time between this support and resistance until we get a breakout. For that reason, I would suggest getting a lot more bullish above 31,000 and then just expecting lower prices until that day comes. On Tesla stock, we were down 2.67% today, and we're getting very close to the rising 50 EMA of support, which is going to be right around 249 to 250. If we break below that, we're looking for the gap fill at 235. And remember, in Tesla, I'm suggesting to wait to get bullish until we break above 274, because you're just going to have a much simpler time not trying to catch a falling knife. Now, if you want to catch the falling knife, manage risk right around 249 and the gap fill at 235. And if we break below 230, you're getting a little risky trying to buy the dip because it is going to look like a falling knife that could keep falling. On Apple stock, we were down 1.55%, sitting right on top of the rising 20 daily moving average, and we did break the support at 194, and we're starting to lose the support trend line. Now keep in mind, Apple has earnings tomorrow, so you might as well just flip a coin on where it's going to go. But it is in a bull trend, still sitting on top of the rising 20 daily moving average, so there's no reason to get overly bearish. However, it's very likely that we are going to fill the gap down there at 191. So if we continue too much lower and we go past the gap fill, we're likely coming back down towards the rising 50 EMA, which is going to be support right around 187 to 188. But again, anything can happen after earnings, and there's just no way to know how that earnings report is going to go. So jumping back over to the S&P 500, there's going to be plenty of noise about the credit downgrade and all of the bears saying we're going to crash, but keep in mind they have been saying that all year long, and if we just zoom out, there's plenty of opportunities on this chart where we had big red candles pulling back and it looked very scary, and those same bears were saying we were in a bear market, we were going to crash, and we were going to spy levels of 350, but the market continued to climb the wall of worry and continued to go higher. The definition of insanity is doing the same exact thing and expecting a different result. And right now, there is nothing on this chart that tells us we need to panic and we need to run for the hills. That can change any day. That's why we do daily analysis. So stay objective and manage your risk and know these critical levels and make sure you have a trade plan that is prepared for any scenario, and then act accordingly on whatever the price action gives you. If you want to come crush this market, consider joining Bank Trade Alerts or the Stocks Channel Discord server. You can find out how to join either service by clicking on the links in the description of this video. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.